In 2024, Bitcoin smashed past $100,000, Ethereum hit new highs, and crypto adoption surged worldwide. But what's coming next? Some experts predict a trillion-dollar shift in the market, a chance that could redefine financial freedom. If you've ever wondered how people profit from crypto, trade in real time, or build wealth through digital assets, this is where it all begins. Cryptocurrency is a digital currency secured by cryptography, making it hard to counterfeit or double spend. Unlike dollars, it isn't controlled by banks or governments. Instead, it runs on blockchain technology, a decentralized system where transactions are recorded publicly, ensuring security and transparency. In 2024, Bitcoin surged past $100,000, and major institutions integrated crypto into finance. In 2025, live trading and real-time transactions are more accessible than ever, with AI-driven bots helping traders navigate volatility. Whether you're investing or trading, understanding cryptocurrencies is key to making smart financial decisions in this evolving landscape. Before diving into live trading, understanding key crypto terms is crucial. A decentralized ledger that records every transaction securely across multiple computers. This prevents fraud, ensures transparency, and eliminates the need for middlemen like banks. A tool for storing and managing cryptocurrencies. Hot wallets, like MetaMask, connect to the internet for quick access but are vulnerable to hacks. Cold wallets, like Ledger, store assets offline, making them much safer for long-term holdings. A unique code that grants full control over your crypto. Losing it means losing your assets permanently. A wallet address that allows others to send you crypto, similar to an email address but encrypted. A marketplace where users buy, sell, and trade cryptocurrencies. Platforms like Coinbase, Binance, and Kraken facilitate these transactions. Any crypto other than Bitcoin, including Ethereum, Solana, and Avalanche, often used in DeFi, NFTs, and smart contracts. By mastering these terms, beginners can trade with confidence, avoid costly mistakes, and navigate the fast-moving crypto space in 2025. A blockchain is a digital ledger that records transactions in blocks, linked together in a secure chronological order. Each block contains a set of verified transactions, and once added, it cannot be altered without changing all subsequent blocks, making fraud nearly impossible. Unlike traditional databases controlled by banks or governments, blockchain runs on a decentralized network of computers, ensuring transparency and security. In live trading, blockchain enables instant peer-to-peer transactions without middlemen, reducing fees and delays. Major cryptocurrencies like Bitcoin and Ethereum operate on blockchain, making it the backbone of crypto markets. Here's a step-by-step breakdown of how a cryptocurrency transaction works. You start a transaction by entering the recipient's public key and the amount in your crypto wallet. Your wallet then signs the transaction with your private key, proving ownership of the funds. Once signed, the transaction is sent to the blockchain network. Nodes, computers on the network, verify its authenticity, ensuring no double spending. Miners, proof of work, or validators, proof of stake, confirm if the sender has enough balance. If valid, the transaction is included in a group with others waiting to be processed. The validated transactions are combined into a new block. This block undergoes cryptographic processing and is added to the blockchain using a consensus mechanism. Once the block is added, the transaction becomes permanent and cannot be altered. The number of confirmations, blocks added after your transaction, determines final security. Bitcoin may take minutes, while Ethereum, Solana, and Layer 2 networks complete transactions within seconds, making them more suitable for live trading. Investing in crypto can be life-changing, but it requires the right approach. Follow these steps. Before investing, understand the basics of crypto, blockchain, and market trends. Follow reliable sources like CoinDesk, Glassnode, and on-chain analytics platforms to stay updated on market movements and emerging technologies. Use regulated platforms like Coinbase, Binance, or Kraken that offer security, liquidity, and insurance against hacks. Check for low trading fees, ease of use, and available assets before signing up. Never leave large sums on an exchange. Use a hardware wallet like Ledger or Trezor to protect long-term holdings from cyber threats. Enable two-factor authentication, 2FA, for added security. Crypto is volatile. Bitcoin, Ethereum, and blue-chip assets are safer starting points. Only invest what you can afford to lose and use dollar cost averaging, DCA, to minimize risks. Don't put all your funds into one asset. A balanced portfolio with Bitcoin, Ethereum, stablecoins, and promising altcoins reduces risk. Avoid high-risk, low-utility projects unless you fully understand their use case. To effectively manage your cryptocurrency investments, use the right tools. Choose trusted platforms like Coinbase, Binance, and Kraken for trading. These platforms provide security, liquidity, and easy access to various cryptocurrencies. Compare trading fees, deposit methods, withdrawal limits, and security features before selecting an exchange. Look for platforms with strong user reviews and regulatory compliance. Never store large amounts on exchanges. Use hardware wallets like Ledger and Trezor to protect assets from hacks and cyber threats. For frequent transactions, hot wallets like MetaMask and Trust Wallet offer convenience but require extra security measures like two-factor authentication, strong passwords, and backup seed phrases. Monitor market trends with CoinGecko, CoinMarketCap, or Delta to track prices, profits, and portfolio performance in real time. Use CoinTracker or Coinly to automate tax reporting, log transactions, and ensure compliance. Keeping a detailed spreadsheet of trades and holdings helps manage funds effectively, track gains, losses, and prepare for tax season hassle-free. Before we continue, don't forget to hit that like button. It only takes a second, and it helps us spread the word. Let's get back to it. Compounding is a simple yet powerful strategy that can significantly grow your crypto investments over time. Instead of cashing out profits, reinvesting earnings allows your portfolio to increase exponentially. This works best with long-term strategies like staking, yield farming, or dollar cost averaging, DCA, where small, consistent purchases accumulate into a larger sum. By holding assets and reinvesting rewards, you benefit from market upswings, compounding interest, and passive income sources. Even during price dips, staying invested ensures steady portfolio growth, maximizing returns over time, and making compounding an essential tool for long-term crypto success. Understanding market behavior is crucial for making smart trades. This method assesses a cryptocurrency's true value by analyzing its use case, adoption rate, development team, and market demand. Investors look at roadmaps, partnerships, tokenomics, and on-chain activity to determine long-term growth potential. Regulatory developments and market trends also play a key role. This approach relies on charts, historical trends, and indicators like RSI, MACD, and moving averages to forecast price movements. Traders study support and resistance levels, volume trends, and candlestick patterns to identify profitable entry and exit points. They also analyze market sentiment and trading volume to confirm trends. Both methods help investors minimize risk and develop data-driven strategies for better trading decisions. Keeping your assets secure should be your top priority. Here's how to transfer your crypto to cold storage. Choose a trusted hardware wallet like Ledger Nano X or Trezor Model T, known for their high-level security. Set it up by creating a strong PIN, writing down the recovery phrase on paper, never store it digitally, and keeping it in a safe, offline location away from potential threats like hacking or phishing attempts. On your exchange, withdraw your crypto by entering your hardware wallet's public address. Double-check the wallet address before confirming, as transactions cannot be reversed. Once sent, verify the transaction on block explorers like Etherscan or blockchain.com to ensure a successful transfer. Always keep your device firmware updated for added security. By using cold storage, your assets remain protected from cyber attacks, exchange failures, online hacks, and unauthorized access, making it the safest way to store long-term crypto investments. Security is everything in crypto. There is no customer support to retrieve lost funds. Here's how to protect yourself. Protect your crypto by enabling two-factor authentication, 2FA, with apps like Google Authenticator. Avoid SMS, as it's vulnerable to SIM swapping attacks. If holding large amounts, use a hardware wallet like Ledger Nano X or Trezor Model T, which keeps private keys offline and secure from hackers. Phishing scams remain one of the top ways hackers steal crypto. Always double-check URLs, never share your private keys or seed phrase, and be cautious of emails or messages asking for credentials. Diversify your holdings by using hot wallets for daily transactions and cold wallets for long-term storage to minimize risk. Change passwords frequently, use multi-signature authentication, and keep your wallets and software updated to mitigate evolving security threats. Consider using a dedicated hardware device or separate computer for crypto transactions to prevent malware risks. Following these steps will safeguard your assets and prevent devastating losses. Market timing in cryptocurrency is highly unpredictable, even for experienced traders. Prices can swing drastically, making it risky to invest based on short-term movements. This is why dollar-cost averaging DCA is a preferred strategy. Instead of making a lump sum investment at once, DCA involves buying small amounts at regular intervals, reducing the impact of market volatility. For example, if Bitcoin fluctuates between $50,000 and $40,000, consistently investing $100 per week results in an average purchase price over time, minimizing the risk of buying at a peak. This approach helps build long-term wealth without the stress of trying to predict market highs and lows. Many beginners ignore taxes, but they're unavoidable. Most governments classify crypto as a taxable asset, meaning you need to report gains and losses just like stocks. To stay compliant, it's essential to keep track of all transactions using tools like CoinTracker or Coinly, which automatically log your trades and generate tax reports. Understanding tax brackets is also crucial. Long-term holdings, over a year, often qualify for lower tax rates compared to short-term trades. Additionally, some investors minimize taxable events by borrowing against their crypto instead of selling, using their holdings as collateral for loans. Being proactive about tax planning can help you avoid penalties and maximize your investment returns. Apart from trading, there are multiple ways to generate passive income in crypto. Earn passive income by locking up your cryptocurrency to help validate blockchain transactions, or by providing liquidity to decentralized finance (DeFi) platforms. Staking rewards vary based on the network, but can range from 5% to 15% annually, depending on factors like the protocol and lockup period. Yield farming, on the other hand, involves depositing assets into liquidity pools, earning interest, and sometimes governance tokens. While it offers higher potential returns, it carries risks like impermanent loss and smart contract vulnerabilities. Crypto lending platforms like Aave, Compound, and MakerDAO allow users to lend their assets to borrowers and earn interest in return. Unlike traditional banks, these platforms run on smart contracts, eliminating the need for intermediaries. Some platforms also allow users to borrow against their crypto holdings without selling them, making it an effective way to access liquidity without triggering taxable events. The NFT market has evolved beyond digital art into tokenized real-world assets, metaverse properties, and gaming items. Platforms like Decentraland, The Sandbox, and Otherside allow users to buy, sell, and rent virtual land. Brands and investors are increasingly adopting NFTs for ownership verification, gaming rewards, and intellectual property protection. However, NFT values can be highly volatile, making research crucial before investing. Many blockchain projects distribute free tokens to users who hold specific cryptocurrencies, engage in community tasks, or test new features. Notable past airdrops like Uniswap, UNI, Arbitrum, ARB, and Optimism, OP, have rewarded early adopters with substantial payouts. Keeping track of upcoming airdrops through platforms like Airdrop Alert and CoinMarketCap can be a great way to gain free crypto. Some blockchain networks allow individuals to run validator nodes in exchange for rewards. Running a node helps secure the network and process transactions, while operating a full node requires technical expertise and upfront investment. Networks like Ethereum, ETH, Solana, SOL, and Avalanche, AVAX, offer attractive incentives for validators. By diversifying income sources across these methods, investors can maximize returns while reducing risks, making crypto a valuable long-term financial tool beyond just trading. Crypto success is all about education, strategy, and patience. Stay informed, follow your plan, and manage risk wisely. Despite short-term volatility, long-term growth is clear. Like and subscribe if you found this valuable. Drop a comment. What excites you most about crypto in 2025? See you in the next one. Stay tuned.